So thanks again, everyone, for joining us today on our latest webinar in our series in relation to the COVID-19 and everything else that entails. It's been nearly 2 weeks since we last caught up and had a webinar, and quite a lot has happened since then. So what we're going to do today is to look at going through the latest announcements, particularly in relation to the stimulus measures. And at the end, we'll also look at going through a little bit of a panel discussion this week, just to start turning our minds to what things might look in the next 6 to 12 months. So as with the previous webinars, the information that we're talking about today is general in nature. Every client's business is different, and their circumstances are different, and that's certainly becoming apparent as we're working our way through, particularly the JobKeeper rules and legislation. So we'll kick off today, and what we want to talk about today is, as I mentioned before, the latest announcements, particular focus on the JobKeeper, the Cashflow boosts, the New South Wales grants and superannuation. And I'll be joined by Angela Hales, Director in our business and also heading up the tax and accounting division. And we'll sort of work our way through those latest announcements. I'd encourage people to submit questions. If you can do it via the Zoom app, that'd be great. And then once we sort of get through the updates, we'll spend some time on answering those questions as best we can, keeping in mind what we are finding. There are lots of different nuances around these rules that are impacting each business and each employee slightly differently. So please feel free to post your questions through, and we'll spend a little bit more time on this webinar trying to address some of the key questions that clients have and attendees have. And then, as I mentioned, at the end, we'll be joined, also Angela and myself will be joined by Garry Pinch and Nick Fitzgerald, just to have a bit of a discussion as to what business beyond COVID-19 might look like. We're certainly starting to see a certain shift in what's happening certainly within our client base in the last couple of weeks. So we'll have a little bit of a chat about how we see the next 6 to 12 to even 18 months playing out. So I guess we're about into, or we've had 5 weeks of this COVID-19. I guess it depends on when you like to start the count from. I sort of started from when we couldn't go to the footy anymore. That was when I say COVID officially kicked off, and we're 5 weeks in. Certainly the first 3 weeks was really survival mode for a lot of clients, and it was about just getting from day to day. What we've sort of found in the last 2 weeks, while things are still definitely very tough for a number of clients, the mind shift has changed to more of a coping phase that we're in now, and different clients are at different places along that timeline, I guess. But we've had 2 weeks now of a relatively stable environment, which is good. There've been no changes to the lockdown, and now cautiously we're starting to turn our minds to what things might look like in the coming 6 weeks to even 6 months. The New South Wales Premier announced today that schools is intended to go back, albeit at this stage 1 day a week from, I think, the 11th of May. So clearly people are starting to look at what the next 6 weeks and even the next 6 months hold. So we'll launch right in now. I'll just bring Angela into the discussion, and really what we want to have our first chat about is the JobKeeper side of things. And I guess our previous webinar, in some cases for us, maybe was a little bit of an anticlimax, because we expected that week before Easter to have all the answers on JobKeeper, and we didn't. But certainly now, nearly 2 weeks later, we've pretty much got all the key questions answered. So I'd like to bring Angela in and just really what we do know now is that we have a registration process, and it opened yesterday on the 20th of April. So Angela, do you like to sort of, I guess, talk us through the application process and how it looks?
Yeah, sure, Mark. A lot has happened since we had our webinar last 2 weeks ago tomorrow. The announcements were meant to come out sort of overnight before our webinar, and it didn't really clarify much more than we actually knew. Significant amounts of information now available with regards to JobKeeper, and particularly now how to practically start the application process. Well, technically it's not the application process yet, it's probably more the enrolment process. So there are practical things now that employers, employees, and their tax agents can actually start to do to ensure that the business is eligible for JobKeeper payments. So before we just get to the application process, or really the registration process straight away, we're needing employers to look at whether or not they are eligible. And there's lots of different periods that an employer can look at their eligibility. So we've been having those conversations, particularly over the last couple of weeks in preparation for this. So we need, in discussions, consultations with ourselves in lots of instances, because the actual tests and periods that you can choose from are varied. And by looking at particular periods versus other periods, we actually might be able to get somebody in, and maybe even get somebody in earlier than they actually thought that they were going to be entitled to. So firstly, make sure that the employer is eligible. Then there is a process to make sure that you've got eligible employees, but you actually can right now, even without having confirmation that those employees are eligible, but you've probably got at least one in the mix, and largely it's probably at least a business owner in the group. So without knowing your entire amount of employees that are eligible, you can start. So right now, as of yesterday, you can apply from our point of view, it's our tax agent portal, so business online services, and I believe employers can do it themselves through their business portal, through their MyGov ID.
Just on that, Angela, it is only through the MyGov ID now, not through the old, what was it called? The corporate key thing.
Yeah, ours is still portal, but it's still just, we log in differently. Yeah, through the MyGov ID. So it is quite critical that everybody has that. The registration process is really to say that you're actually eligible. You do need to go in saying what period that you're eligible from. That is absolutely critical to get that right, because if you put the wrong period, you're actually potentially saying that you're not eligible until a future period rather than from day dot, which is the 30th of March. And an estimate of your expected number of employees that are going to be eligible, bank account details for the business to apply to get the payments, and that you basically satisfy the criteria. You can do that, and it's very important the timing of this is done correctly, because at the moment the ATO is saying that you need to enrol by the end of April. There was comments that it was actually the 26th of April, which would mean this next Sunday. Then there's comments about that it's actually the 30th of April, and then there's comments that it actually might have an extension, which haven't been confirmed. But right now we're working towards the end of April in enrolling everybody, because you actually don't apply until at least the 4th of May, so another week after that, where that's when you actually need to get the documentation all sorted out, and to make sure that you've actually got the list of eligible employees and so forth. So right now, enrolment is critical to make sure you're in, and then the application process will be following shortly.
So just touching on that, what we need to do is, firstly, we need to assess whether or not we've had our reduction of turnover, and we'll talk a little bit more about that in a second. Then we need to identify how many employees we might have, and the period that it relates to, bank account details, and that's probably the extent of the, I guess, the enrolment part of things. So not overly onerous at this point in terms of actually the filling in of the form. I guess that the main thing is around determining the turnover. But it's also important between now and the 30th of April, there's a number of administrative things that need to happen within each business to make sure that we're able to make a claim for the wages in the month of April. So I guess the first one is about making sure we're paying our employees.
Yeah. So if you're determining, a business will need to look at who they are anticipating would be their eligible employees. So they could all automatically potentially knock out some of those employees just based on the simple criteria that's available. For example, that they're if they're under 16, they're out. If they were casual for less than 12 months, they're out. If they're a non-resident or not a New Zealand resident, they're out. So certain criteria you could potentially look at getting those employees out of your list as it is. So people that you're thinking that you are eligible for, the employer has to notify those employees that you're looking at registering for them, and then give them an employee nomination form which they need to complete. And in that process, the employee is confirming those details about themselves and their eligibility. And also in that instance, they will evaluate whether or not they're actually able to be an eligible employee for that employer. So for example, if they're only casual for this particular employer, but they've actually got another permanent employer, then they're actually not eligible. They have to go with a permanent employer. There's also the definition of primary employer. So some employees have multiple employers and will need to choose their primary employer. So on the surface, it might look like that most of your employees are eligible, but there might be some that actually, in filling out the form, have to determine that they're actually not eligible for your business. When you get that, really get that back, the critical things for April is what we really need to focus on. And the main thing is that you get these nomination forms back from the eligible employees to know if it's a yes or a no, but you need to make sure you pay the minimum amount to that those employees, which is $1,500 gross a fortnight equivalent for the month of April before the end of April, to make sure that they're actually then able to be claimed for April. So it is very important that those nomination forms go out and get back as soon as possible, because we want to make sure employers aren't actually potentially topping up employees that actually are not going to be eligible for the JobKeeper, and protect themselves in that respect. And it's really important. Part of the administration is actually a lot of bookkeeping type entries, your payroll system, actually setting up for single touch payroll, or creating. All of the software providers have new payroll items that are required for JobKeeper, and they're specific and if you get that wrong in the setup, then you actually are ineligible. So we've seen the QuickBooks Online setup, we've seen the zero setup, and it's quite particular about how it actually needs to be set up. And if you get it wrong, you could actually be ineligible, even if you've made the top-up payments.
Yeah, so I guess where we're up to at the moment, it's the 21st of April. And really what you've just identified there is that I guess one of the big risks to employers is that they top their employees' wages up for the month up to the $750 a week or the $1,500 a fortnight. I guess on the basis that they're assuming that their employee is eligible, and then they either don't get a notice back, or they get a notice back saying from a particular employee, I'm actually claiming the JobKeeper from someone else. And what's happened is you've actually paid this employee when they may have been stood down. So that's a really important point. And we're talking now the 21st of April, so we don't have a lot of time. We need to get those forms out to employees, and more importantly, get them back to enable us to make sure that we're paying the right people prior to the 30th of April.
Because the single touch payroll, the reporting side of that is then a critical part of the next process, which is then the application process. So critically in April is actually enrolling if you're actually going to be entitled, after we get to the next part about our eligibility as an employer. Then looking at the employees, that part, and making sure we've actually got all our eligible employees sorted out. paying them all, physically paying them all, and then getting the payroll entries right through the software.
Yeah. Now, you mentioned single touch payroll. Certainly some of our clients aren't required to be on single touch payroll until the 1st of July. I believe the ATO have said that you can still access the JobKeeper if you're not on single touch payroll, but it will be an actual manual process. So there'll be more paperwork to fill in, and it could delay the payment of the money back to the client. So I guess our preference is that if we need to set up single touch payroll in a couple of months anyway, let's do it now and speed up the flow of money into the business.
Definitely, that's our preference, because we are only talking about the next quarter that they'd be required to report anyway. And if we can at least get any money to businesses sooner rather than later, well, that would be our preference to help the clients out.
So once we've got to the 30th of April, there's then another process that we need to go through in actually claiming the money. Can you shed any light on how that works from a practical sense?
Yep, so the information at the moment is from the 4th of May that applications will open, and again through the online services for business through your MyGov ID. They, in that period, it's when you'll be confirming your number of eligible employees for that first period. So the claim opening up at that time will be for the first 2 fortnights in April. So the people who have said that they're eligible from April or from the 30th of March. And at that time, you'll be asked to confirm your number, because as I said in an enrolment, you could have put in an expected number. So it's a confirmation. You can choose to confirm based on pre-populated data from your single touch payroll software, and alternatively, there'll be a manual process for those people who are not on single touch payroll. There'll be some criteria around, obviously, just your declarations about confirming that you're actually entitled now, rather than just essentially enrolling, that you effectively do meet the turnover test reduction, potentially some projections are confirming the number of employees, and some declarations that you've actually paid them all the correct amount, which in some respects, if you're using single touch payroll, they will know. But you've got to do some declarations, and at that time, then they'll process your application and release the funds. After that, which won't be too far away from that, is that there's an end of month reporting process as well. So this will go through for the entire 6 months of the JobKeeper program. So at the end of any calendar month, you have to the 7th day of the following month to then complete a monthly report, again through the online services, through MyGov ID, which is some further declarations about your current your turnover, your projections, and so forth. The one thing to note there is that whilst there is this ongoing monthly reporting requirement to maintain your eligibility, they are not using that data either in your current nor your future projections after that date to then reassess you to say, oh, but now you're not eligible, or you've recovered too well and you actually were never eligible from the beginning. It's not a retest of your eligibility. Their comments was that it's going to be used more for statistical purposes and see our economy recovering out of this, rather than it's not a retest for that particular business. So it is okay that you do see improvements in your monthly reporting later. But it's actually really important, just on reporting, on the slide just there, is there a particular, what they call prepayment reporting requirements and then post-payment reporting requirements. And they're just saying that if you fail either of those two things, it will actually null void your eligibility. Now, prepayments are things like anything that you put in any application, you have to have supporting evidence for. So that's in your payroll that you're doing per fortnight, per month, your actual initial applications, you actually have to have supporting evidence and can be required to actually produce that if you're asked. So if you cannot, then you actually will forfeit your eligibility and have to pay things back. And then there's a post-reporting requirement as well, where you have to keep everything for the normal period of that employers have to for 5 years after payments are made. So it's absolutely critical, and we're quite strong about work papers and calculations and supporting evidence to ensure that clients are eligible and not going to jeopardise if having to pay back any of that money because they've just missed something small and minor which may have been overlooked and it doesn't seem material. But the ATO are being quite particular in saying that everything is material and supporting evidence is required for everything.
So that's probably a good segue, I guess, into the next little part, which is this reduction in turnover. So we've known all along that it's a 30% reduction in turnover, but certainly in the last week, we've had a lot more clarification in relation to comparison periods and the like. So I guess in terms of the comparison period, how are we able to measure our reduction in turnover? Against what period are we able to do it?
Okay, so firstly, it's any calendar month that ends 31st of March up to the end of September. So effectively, you can use the month of March, April, May, June, July, August, and September as an isolated month. It does not matter that your GST reporting period may be monthly or quarterly. You can choose a calendar month. Alternatively, you can use a quarter, which would be the April, May, June quarter, or the July, August and September quarter. Now you've got to choose as your turnover test period will be one of those months or quarters, and then your comparison period will be for what they call the basic test, will be the equivalent month or quarter in the 2019. That's the go-to initial tests.
And I guess in relation to that is once we pass the test in a particular period, whether it be March, whether it be April, whether it be the quarter, April, May and June, we're in the system forever. It doesn't matter what happens after that.
Yeah, and that future monthly reporting, what you're putting down does not, as I said, doesn't jeopardise your eligibility. The one thing that got clarified, and it was only, I can't remember, it was only yesterday or the day before, but something that we were waiting on the answer for because it is quite material to doing these calculations, is it's only just being confirmed what method you actually can use, whether or not it's on a cash basis or accrual basis. So people who lodge their BAS statements on an accruals basis, their turnover tests will be run on an accruals basis for both the current test period and the comparison period. For those people that lodge their BASs on a cash basis, you actually have both options. So you start with your accruals method, and then you, as long as you're, as I said, the turnover test period and the comparative period are run both on accrual, and you can run them both on a cash basis and see if you are eligible in either of those ways. So the people on a cash basis have the two options, people on accruals basis only the one option. But that's a major thing, because sometimes businesses are still being able to work, but their payment terms for customers are significantly jeopardised, and they're just not getting the cash in the door, even though they're working. So they might be able to get over the test maybe on a cash basis where they can't on an accrual, or vice versa.
Yeah, and we had a question in relation to that particular issue about whether we can choose cash or accrual. I guess for those, as you've said, for those that are on a cash basis have the choice. For those that are on accrual have to use accrual, but you need to be using the same method, cash or accrual, when you're comparing each year. So you can't compare cash in 2020 to accruals in 2019. It's got to be Definitely. Cash for both of them. Yeah. I guess probably what we're sort of starting to see when we're going through these processes is there are some businesses that either pass that test quite easily in a particular month. And we're talking about businesses that receive quite lumpy income, particularly in the building industry and that sort of stuff. Probably our advice to clients there is that we'd want to make sure that our calculation of turnover is appropriate, particularly where we might be receiving some income in advance or did receive income in advance in the previous year. So there will be particular businesses where we might be suggesting that you need to, I guess, dig a little bit deeper into the numbers. On face value, it might look like you pass in March, but then it might be that we need to go and have a look, as I said, for in the building industry in relation to work in progress and the like, just to cover all bases. But really the important thing is that if we're looking to get into the system in forecasting a reduction in turnover, so we might be saying for April, May and June, we think we're going to be 30% down. We need to have some evidence as to how we've calculated that forecast. And that might be doing an analysis of forward bookings or the like. But we need to prepare ourselves that we could get asked a question as to how we came up with that estimate of turnover. Now, if we estimate our turnover is going to be $100,000 and it ends up being $130,000, well, my understanding is that doesn't matter as long as our estimate was below 30%. But then we might be asked to come back and justify how we came up with that estimate. So we just need to be careful.
Yeah, and also just in people doing their own calculations on their turnover, is they've still got to look at the definition of GST turnover. So it's not necessarily just what's on your profit and loss that initially just comes up. It's not even necessarily what comes up if you just ran out of your software your GST report either, because there are certain things in the definition of GST turnover that actually is excluded. We actually may report on your BAS that actually isn't part of the turnover threshold. So input tax supplies, bank interest, dividends, residential rent, other investment income, and overseas sales. So it's important that we actually, this part of the substantiation part is actually doing the numbers and really looking at what the numbers are, not just assuming that it's just the number that your report just ran, but being able to make sure it actually does satisfy the definition.
Yep. And now we have mentioned there's an alternative test. So and that test is going to apply to businesses that might have been significantly impacted by some sort of event in the previous year. The most likely one, or one of the common ones, being drought. A lot of businesses were drought affected in the 2019 financial year, which when they're comparing that to 2020 might not give a realistic comparison, and also startups. So we know that there's an alternative test for that the ATO are going to administer, but we don't know yet what that is.
We don't know whether or not the client has the ability, or the taxpayer has the ability to give some input about what is normal for their business versus what then is different in the test period, and to basically try to identify what is the best comparable period for their business, whether or not the ATO is going to have some predetermined information about that based on a startup or pre-drought, depending on when they determine that to be, or even businesses that were in a high growth period potentially before, and something, it's just that the period needs to be in consultation with that commissioner's discretion, is how much input does the entity themselves have in saying what actually should be used as the comparative period. We don't know that information just yet.
Yeah. And then I guess just to cover off on that reduction in turnover, we want to make sure that we can substantiate either our actual reduction or our forecasted reduction. We need to be able to have some evidence that we've, had a proper, made a proper go at forecasting our decline in revenue.
Yeah, and this is that part about the prepayment reporting requirement that the ATO requires.
And for some businesses, that's going to be easy because they've either shut down, restaurants and cafes. It's going to be quite easy for them to substantiate their reduction in turnover. But for other businesses, particularly what we're seeing is some businesses have had a really good March, so they haven't experienced their reduction in turnover in March. Some businesses are starting to see it in April, and they may get in on April alone. But a lot of people, and we've got clients out there who've seen a reduction in forward bookings and that sort of stuff. But that might not hit until May. So those businesses that probably don't meet the 30% reduction until May, I guess have two options. One is they can wait until May to register. Alternatively, they can forecast a 30% reduction for April, May and June and get into the system in April.
Yeah. We don't want people legitimately having forecasts that see them go, being eligible for the quarter and then holding off till potentially May and so forth. When you're talking about it's the equivalent of $3,000 per employee per month that they could have been missing out on. And if you've got legitimate forecasts, then at the end of the day, if it turns out that you actually didn't satisfy it, then you've got to evaluate whether or not the risk of having to pay that back versus not getting it at all and you were eligible. Where do you stand there?
So if we move on, we'll move on now to just some issues around employees.
Yep.
And we've now got this concept of what's called a business participation entitlement, which basically does allow sole traders, partners in partnerships, and I guess people that are operating through a company or a trust structure that aren't taking a wage as such, but are being remunerated in the form of a trust distribution or a dividend. So we might just touch briefly on what that entails.
Yes. So we have a clarification that, so we're not talking about people that are employed by their entity. So a director that is actually an employee, somebody working in their trust that's actually an employee. So taking the employment relationship out, they're already going to qualify as a legitimate employee. But we have businesses, the most common question we're getting largely is, say, sole traders. So I'll start there first. They're basically treating a sole trader as if you're effectively an employee. So clearly you're not an employee, can't be an employee of yourself, but they're going to treat you as if you're eligible just like you were an employee. The enrolment process, we haven't seen the application process, and it's designed to be a little bit different to employees, because clearly you don't have STP and you don't have the normal employee reporting requirements. So there will be a difference in the application process. But the actual enrolment process is a question is, are you actually applying for a business participant? So separate to being an employee? Yes. How many? And the right now we haven't seen in the couple that we have done that it actually is asking to nominate that particular individual yet, specifically in that enrolment process. But it does actually ask you to nominate them, still do the same, like the bank account details and how many, it's only a big one. But it's not actually specifically at the moment asking who is that eligible employee. So yes, a sole trader is definitely eligible. Don't have to have a single employee, you can just be working for yourself. So over the 6-month period of time, that is worth $19,500 gross.
So we've had, sorry, I just cut in there. We have had a couple of questions in relation to sole traders specifically about the application process. So from what we know so far, the actual initial enrolment, there's a separate section where you need to justify your reduction in turnover. The number of eligible employees, well, that will depend on whether the sole trader is employing or not. Some sole traders employ. But then there's a second section there, number of eligible business participants. So that's where they would indicate that for a sole trader, there's one additional business participant and gets them in the system that way. In terms of the other part of that is clearly sole traders don't do payroll. They're not as part of the payroll system. They're not actually paying themselves $750 a week. So there was a question around that, is how do we handle the payroll reporting when we don't have to pay ourselves?
You don't need to, effectively, because there is none. The actual application process is just different. We know it's different. We know that they've said that there's going to be information there that they will need to provide, like the same thing, like the turnover and that kind of stuff. But the actual eligibility, the part that we'd normally fill out for the employees through STP or even the manual process isn't the same. It'll just be a different version of how you do the application. But what they said it should involve should be quite logical, be able to be met. When you actually are doing the enrollment process now, it starts off with your employees and how many do you have, and then the next question is, do you then want to add a business participant? So say a sole trader or any other entity could actually have employees on the books for external people, and then they go down. The next question is actually about them personally themselves, and that's how they get in from that enrolment process. So
pre 30th of April, no requirement to take $750 a week out of the business if you're a sole trader, and it won't be until we do, I guess, the third step in that process, which is in early May, where we actually nominate who that person is to the tax office.
Correct. Now, the same thing generally, and in some respects, applies now then to partnerships. So a partnership is going to be treated more like a sole trader in the sense that they have to nominate a single partner. and doesn't matter if that's a two-way partnership, a three-way, four-way or whatever, but a single partner will be nominated. And might seem that that's unfair, particularly if you've got non-related partners in a partnership, but the ATO have acknowledged that actually is the case, and it's really just, well, that's the rules and that's how it is. So a partner gets to nominate one. And then the more complex ones we're seeing is with then the, say, companies and shareholders, companies and trusts, where, for example, we may have a business being operated through a trading trust. One of the business owners is actually on the books as an employee, but potentially their spouse is actually being paid trust distributions and not formally as an employee. If they are legitimately, so the actual definition of your entitlement is that you need to be actively engaged in the operations of the business. So we're not talking about people who just have, there are other employment elsewhere and they're not actually physically working in the business, but there are particularly family businesses. It's just that one family member doesn't get paid as an actual wage, but gets a distribution. And it could be an adult child too, as long as they're an adult. So there are sometimes now where we can get the eligible business participant for potentially that spouse who's actually just not on the payroll. So we want the evidence of what type of work they do to make sure they actually are actively engaged. So again, that's part of that record keeping. But where you thought you'd maybe just be limited to employees, particularly including a business owner, that actually now extends to potentially one extra person, which could then make an extra $9,500 over the 6 months for that business. Same thing with companies is that if people are being paid for labour in the form of dividends instead of being on wages, then they could become a business participation eligible business participant. The one thing that you do need to note is that, and this is the same for whether or not you're looking at one of your employees being eligible or yourselves in the business participant eligibility, is that you can't have permanent employment elsewhere. So we're looking at different structures to work out that maybe we can't use the spouse, but there might be some adult children in the mix that actually legitimately do work and they get paid a distribution that we could actually nominate as the eligible business participant there. So it's quite critical to look at your overall scenario and actually see, are you maximising this for your business? And it's very costly to you if you actually don't look that far and think you're not eligible when it could cost you nearly 20 grand. But it is restricted to one eligible business participant per business. It's just up to who you nominate.
And I guess where we're seeing the most drama in relation to that criteria around one eligible business participant is in relationship to partnerships, and particularly partnerships who are with, you're not your mum and dad partnership, but you're unrelated arm's length partners. It's becoming quite clear that only one of those partners is going to be eligible.
Yeah.
Which is, at this stage, I haven't seen anything that suggests that that's going to be changed. There's certainly some lobbying going on, but yeah, we haven't seen anything.
I just want to add to this because a question that's been raised before we move on, and it's to these employees. Oh no, it's actually on the list anyway. Just the super question. So I'll leave that.
Just a quick one around workers' comp. That's probably something that's come up in the last 2 weeks. The JobKeeper payment is subject to workers' comp.
Yeah, we weren't very anticipating that answer, really, and wanted to push back and actually query whether or not that's actually right. But if you look at iCare, that oversees pretty much all the workers' comp policies, that it actually does say that it is going to be treated as eligible wages and that it does count for your policies.
So you'll need to include the JobKeeper amount, particularly for those employees where it's an issue is where they're being stood down in full, not actually working. We're still paying workers' comp premiums on their JobKeeper payment. So whether that changes down the track, we're not sure. We haven't really heard the implications for payroll tax and other things yet. We'll move on to superannuation, and there was a question around superannuation and how that works with the JobKeeper payment.
Yeah, so superannuation needs to be paid on what would be an employee's ordinary wages. So If they're actually stood down and they're just getting the JobKeeper payment, then their ordinary wages component is 0, so they won't be getting any superannuation. You don't have to pay superannuation on the JobKeeper top-up component. If somebody is earning their normal wages and actually earn more than the $1,500 per fortnight, then nothing changes. You pay your superannuation on their normal wages, which is the larger amount. If you have got a situation where your employees are on reduced wages, or earn under the $1,500 a fortnight, and that you're topping them up with the JobKeeper payment, then superannuation needs only to be paid on what they ordinarily get paid as their wages, what they're working for, excluding that top-up component. So it's quite critical when you're then looking at how your payroll is set up within your payroll software, that all the payroll items are set up correctly, so that you're actually not accruing superannuation on the JobKeeper top-up component.
Yeah. And then probably the last thing just on the JobKeeper, and I know we've spent quite a bit of time on it, but it's probably the most pressing thing at the moment, is around annual leave. And that's more to confirm that employers can top up their employees if they're paying them up to the $750 a week, and the employee might only get $500 a week. They can top that up with annual leave to get to the $750.
Yes, an employer can ask an employee to take leave, take annual leave, to effectively bring them up to what they to that $1,500 a fortnight minimum that they need to get paid. It is legal for an employer to do that, and part of the reason is that an employee actually is accruing annual leave for the period that they get the JobKeeper. So for example, if they are stood down, so the business actually, there's no working being done, and they were ordinarily full-time employees, then they're actually accruing full-time leave entitlements for the period that they're actually not working, which is a cost that the employer will ultimately bear down the track when they need to pay it out. So that's some of the comparison of the fairness, essentially, of that. So what you need to know is that annual leave needs to be accrued, how it was being accrued for that employee before any reduction in work hours, before stand down, before reduced hours, before any changes. They need to be accruing their entitlements as if the stand down or whatever didn't actually happen, which they call employer enabling directions. Or so again, it's something that you need to make sure that your payroll software is actually doing correctly, because in the top up for somebody using a JobKeeper top up code could be different if your employee is actually full time, if your employee was part time, if your employee was many hours in between, any of that. All of their leave accruals are actually different. So that is very important to do.
All right, we might leave JobKeeper for the time being. Again, if there are any additional questions, I think we've actually got to most of the questions in specifically related to JobKeeper, which is good. We might turn our attention now to the cash flow boosts. And I guess the main thing is we're actually seeing the payments and credits to the accounts are actually happening as we speak. So the wheels are all in motion there, and the ATO is processing those cash flow boosts.
Yep. For a BAS that we lodged yesterday, you can actually now see that the ATO has applied on the integrated client account the credit, and it's called a cash flow boost initial payment 1 or something like that. They're actually crediting that already, and your balance actually shows as the new amount, the reduced amount payable, if you still actually had a payable amount. We're led to believe that even for those people who are their cash flow boost will generate them a refund, that sort of credit amount is sitting on the integrated client account. At the moment, it's still not yet paid out, but it is actually sitting there ready to pay out, because the ATO said it was going to be within 14 days of the 28th of April. So whether or not that actually physically comes out earlier than that or not, but that's the time frame that they've set at the moment. But it actually is reducing your payables at the moment. What quite critically, just for people to remember, which is really partly the next part, and someone's asked a question about this, is that if you have existing debts, the ATO will take your cash flow boost against those existing debts. If, however, you enter into a payment arrangement, or sorry, payment deferral for those original debts, then they won't. They're meant to, those initial payment debts are deferred, not actually due and payable now, which means that the cash flow boost refund will actually come out as cash now. So what we're looking at now is looking at people who have existing debts, identifying those and trying to enter payment deferrals, and then potentially even then payment deferrals for the March BAS. So you actually can, if you think that your cash flow is going to generate you a refund, you can actually get a deferral, payment deferral for your March BAS before you've even lodged a March BAS. So therefore, when you actually do lodge a March BAS, it actually will then generate your credit out. Otherwise, if you don't do that ahead of time, it will simply take the cash flow boost against the March BAS payable part.
And I guess just to point out, our discussions certainly that we've had around the office, virtually around the office, with our different staff members have been that the ATO systems might not be, I guess, coping with this the way that they intended it to do. So I suspect there might be a few hiccups in the first couple of weeks just around how they're applying those boosts. So we're keeping an eye on that. But I know certainly Lisa from our office was talking to the ATO yesterday, and the lady at the ATO was quite concerned that the system wasn't applying the boost payments the way that she thought it would. So hopefully that'll settle itself down in the coming couple of weeks. So, but I guess the main thing there is that that's probably been the first sort of flow of money, certainly from the federal government into businesses' hands as this cash flow boost. It's actually happening, which is good. We might turn our attention quickly to the New South Wales grant funding, because we've actually made a few claims in relation to this grant. Angela, could you just quickly re-go over the eligibility criteria?
Sure. So the first thing is that they need to be an employer. So they do need to have between 1 and 19 employees. They need to have a turnover of more than $75,000, which is basically the GST registration threshold. So that means that you would be doing BASs. You need to have a payroll below the payroll tax current threshold for 2020, which is $900,000. So below that, have an ABN on the 1st of March. And you need to be significantly or highly impacted. And the definition of that is that your business has seen a reduction in turnover of more than 75%. So it definitely impacts those ones who clearly have closed their doors. But the eligibility, when you actually have to support that reduction, is that it's actually only for a 2-week period that you need to substantiate that your business had this reduction for. So part of the application process is through Service New South Wales online. Supporting documentation is some BASs to actually prove your turnover is greater than $75,000, and a letter from your accountant, which that's largely our biggest part that we've been involved in. Initially, the website documentation says that we should only have to provide that letter for businesses who are not currently in the highly impacted list of industries, list of businesses, because actually is a published list. But we actually have had at least one client who was in that list, went through the eligible process and online and so forth, and got to the section where it still made them get a letter from the accountant. So that's contradictory to what we thought, but it wouldn't let the client proceed until they got that letter from us and that we were able to upload it. So I'm not sure why that was the case, but they definitely were in that highly impacted list of employers. And in that letter, we have to substantiate the criteria that the business satisfies and nominate this particular 2-week period to a comparative 2-week period to show the reduction. And then they submit it online. We have heard that businesses were getting paid, with those people who applied were getting approval within a week and payments within a week. So it wasn't a really large time frame, which is great. Applications don't close until the 1st of June, so there isn't a huge rush to have to do this right now. But clearly, people who need cash can do it as soon as they actually require, but there isn't a need to rush. You're not going to be ineligible just because you don't do it straight away.
Thanks for that. I'll just move on to touch quickly on the early access to super. So this became available from yesterday as well. This was announced as one of the earlier stimulus measures where eligible people could take $10,000 out of their superannuation prior to the 30th of June, and then a further $10,000 from the 1st of July up until the 24th of September. So we've had quite a few inquiries in relation to that. I guess the main thing is the eligibility. So it applies if you're unemployed, if you're entitled to the job seeker payment, or on or after the 1st of January 2020, you were made redundant, your working hours were reduced by 20% or more. So that criteria is based on hours worked. It's not tied to earnings, it's hours worked. Or if you're a sole trader, there's a reduction of your turnover by 20% or more. So again, that gets back to a turnover test. So quite a number of people are going to be eligible for that. As I said, it's $10,000 before the end of June, $10,000 after the end of June. I guess the application process there is through MyGov. So if you go into your MyGov, you can track it has a list of your superannuation accounts, and you can follow the application process from there. It is done, administered, and what will happen is the ATO will give the super fund a temporary condition of release to allow you to to allow them to pay you the money. The money's not taxable in your own hands. The other thing for those clients that have self-managed super funds, it's just not a matter of going and taking the money out of the fund. You still need to go through that application process and get that elite release authority from the ATO through the MyGov in order to take that money out. So I just wanted to touch on that it is open. It is quite popular. I guess the bigger question that we won't go through today is what are the merits of doing it, and should or shouldn't you do it? And that's an entirely different conversation. But for the purposes of today, it's open now for those clients that would like to get access. So that probably brings us to the end of the update in relation to the stimulus type measures. We have gone through and answered most of the questions on the chat there. Probably one that I will go through. We've had the discussion about whether we've done any calculations or we could add any, insight as to whether clients should opt for a job seeker payment as opposed to a JobKeeper payment. What we do know, one of the things in relation to the JobKeeper is it's one in, all in. So if you're doing it for one employee, you do it for all employees, unless they're ineligible. Now, keeping in mind an employee can make themselves ineligible. The amounts are different. So it's $1,500 for the JobKeeper and $1,100 for the job seeker. Although I do believe on the job seeker, there's a number of other potential benefits there with health cards and rent subsidies and the like. I guess, and before I throw that open to anyone else that wants to jump in, the main thing is that the job seeker payment is income tested. So they will look at the other income that you're earning before you are eligible to receive that payment, where the JobKeeper payment isn't income tested. So it doesn't rely on how much your spouse is earning, and it doesn't stop you from earning additional income while you've been stood down or while you're receiving that JobKeeper payment. I don't know if if either Gary or Nick or Angela wants to shed any more light on that question when I unmute you.
I agree with everything you said there.
Yeah, look, I agree as well, Mark. Probably the only thing is that the spouse income test for job seeker, I believe, has also been increased to about $79,000. And so if you were receiving JobKeeper and you had a spouse who wasn't working and wanted to qualify for JobSeeker, they may still qualify if you're still only on the minimum $1,500 a fortnight under JobKeeper, because you'd be under that $79,000.
Yep. I'm just going to pop you all on gallery view now. We'll see if that works. Just with that, what we have done is we have done some analysis between whether the apprentice payment in New South Wales is more beneficial than the JobKeeper payment, and our I guess our early calculations are that you're better off claiming the JobKeeper for your apprentices rather than the 50% apprentice subsidy. Once we hit the 30th of March, so from January up until at the end of March, we would claim the apprentice subsidy, and then we'd flick them to JobKeeper. So I think to be worse off under the JobKeeper, the apprentice would need to be earning about $78,000 or something like that, which is clearly more than what most apprentices are earning. Just looking at other questions. Again, around the annual leave, I will read the question out, and one of you guys can jump in. If we're asking staff to take annual leave to top up to $1,500 a fortnight, do we need to leave them with the 2-week buffer of annual leave as per the legislation?
Definitely. So the answer is that you would pay them the equivalent annual leave hours up for the dollar value, up to getting up to the $1,500. They must maintain a minimum 2 weeks annual leave balance. Anybody who has less than that, you can't even ask them to take any leave at all. But what's very critical in all of this is that when you're either reducing hours or even paying out their leave, the employee must be paid at their pre-existing hourly rate. So if they were on effectively equivalent of $50 an hour, then there has to be $50 an hour equivalent for either taking their leave or even on their the reduced number of hours. Yeah.
So if someone normally would receive $1,200 a fortnight, then we're basically asking them to take leave to the equivalent of $300 to top them up to the payment, provided they've got the 2 weeks left. There was also another question which I received via email yesterday, which I actually don't have in front of me, but it was in relation to visa requirements. So whether the JobKeeper payment was applicable to people that were on different, I guess, subclasses of visa. We know that I think it's the 444 visa that applies to New Zealand residents, that they will be eligible for JobKeeper. I don't know if either of or any of you have seen any information in regards to people holding other working visas.
No,
yeah, my understanding is that they were the only ones that it was going to apply to.
Yeah.
So I think we've probably got through most of or all of the questions, which is good. If there are some questions that you've got additional questions, please keep them coming through and we'll get to them at the end. There's now 2 more quick ones. Do we pay super on annual leave used? The answer to that question is yes. Because annual leave is ordinary times earnings. So there is super on annual leave used. And when topping up the JobKeeper with annual leave, do you need to pay annual leave loading?
It will be the same as however your leave should be paid in ordinary circumstances.
Yeah. So if the employee was normally entitled to leave loading, then you would pay leave loading on top of that.
It would form part of the 1,500.
Yeah.
I would assume.
Yep.
Just on the annual leave, Mark, I guess one of the discussions we had internally was around the merits of employers asking their staff to take annual leave if they've got more than 2 weeks. And I guess one of the things we probably haven't touched on today is that whilst some employees may feel that it's a little bit unfair, the merits to the employer and the logic behind it really is that when businesses who have staff stood down are able to reboot, that they have staff available who don't have implanted leave balances who then want to go on holidays as well.
Yep. Alrighty, so what we might do, we might move on and again, just have a bit of a chat around what business might look like beyond COVID-19. And I guess I'm probably a little bit optimistic on the way things are going at this stage. You can see the light at the end of the tunnel, hoping that that light's not a train coming in the opposite direction and is actually the end of the tunnel. But I guess I'm cautiously optimistic. I think what's happening is that the JobKeeper payment seems to be having an impact. And I say that in relation to what's going on, not only within our client base, but just in the general area around the office. A lot of the restaurants have reopened, albeit as takeaway only. So there are a number of restaurants, Nardies that are below us, Grilled, Coffee Club, and the like that were closed as a result of this that have now started to reopen for takeaway only. And I can only suspect that that's primarily in part to the, I guess, the certainty around having the JobKeeper payment there to take away some of the cost burden and potentially also the impact of the rent reductions and the like. So I guess really early on, we're sort of seeing some businesses sort of bounce back, but I guess the concern is that might be only a short-term bounce back, and the impact of this is going to be with us for much longer. So I know, Gary, you've got some views on that, and it's been a sort of part of our discussion within the office. So do you want to share your thoughts on that?
Yeah, sure. Look, it seems likely that there will be we'll have a staged recovery, both in regard to industries. Different states will recover at different rates because of government decisions. So we're going to have different decisions, both at state and federal government, about when businesses opened up. So I think, all businesses need to probably keep an eye on what's happening in their state, their industry, because I think that will be a significant determiner to how quickly the businesses recover. I think certainly it looks likely that that recovery for most businesses, or at least a reopening, should occur in the next 6 weeks to 6 months. But the recovery, I would suspect, is going to be longer than that. And for some businesses, the recovery is going to be their business is going to look something significantly different to what happened before the close down or lockdown. So it's something to certainly keep in mind, that it's clearly seems to be that the businesses that are agile, have adapted or adopted automation, will be advantaged. And a lot of times that a lot of small businesses would perceive that larger businesses are advantaged in that space. But history would indicate that smaller businesses are the ones that are more agile and can adopt automation and digitize their service offering faster. And history would indicate that the larger businesses are really slow to adapt. What's also probably relevant is a lot of the trends that were developing prior to being locked down have actually accelerated. Sometimes you think about, we hear about those things, but we've probably also realised them. That we think about there was a transition away from cash to credit cards and digital payment type systems. That's accelerated. There's a lot of stores now, even Woolworths and Coles, who've basically have indicated that they won't accept cash in a lot of places as a means of currency. So that will accelerate even faster. Restaurants and bars have been forced to adapt to a takeaway model. It's clear that those takeaway and online models for bars and restaurants are not likely to disappear and for a bar and restaurant to go back to solely face-to-face service offering. So there's a whole stack of trends that would normally have taken probably 10 years that have been accelerated over a period of 6 to 8 weeks, which are here forever for us. That's probably should be a positive thing, but it's also something that businesses will need to adapt to really quickly. Some have adapted fast already. Others will need to get onto that bandwagon. I think the other side I'd say about innovation is that sometimes there's a danger innovating too quickly. And we've talked about length at different points in time about being an innovator or an adapter or an early follower. And often being that quick innovative business can come at a significant cost, and being an earlier follower can be more profitable. So all those sort of trends are worthwhile contemplating moving forward.
Yeah, and I guess in relation to our own business here, not having seen clients now for the best part of a month face to face. Now that's something that we would do the odd Zoom or Skype session with clients if they were in a remote location or couldn't physically get here. But I guess what we've done over the last month or so is had to adapt and find a different way to interact with clients. And it'll be interesting from our point of view where the dust settles there. I suspect that some clients will still prefer to come in and sit with us, and that's fine. But a number of other clients may prefer to stay at home or stay in their business premises and conduct meetings like we're doing today. So, the same can be said for staff and working from home as well. So, I think change has been forced upon us, and some businesses are dealing with it well, and others are struggling. I should probably throw a question over to Nick without notice. So good luck. I guess one of the things is do you think that businesses will come out better at the end of all this?
Thanks for the notice. Look, it's going to be a mixed bag. I think the businesses that have that strategic mindset right from the outset, I've got no doubt they'll come out the other side better, because I take heart from what I'm seeing with a lot of our clients, where they're seeing some great opportunities presenting themselves to them to do things better, to innovate their business like Gary touched on. I think probably a little bit in line with what Gary touched on, some larger businesses or some older businesses may struggle to innovate, and as a result may actually come out the other side worse off. But it will create new markets and new opportunities as well.
Yeah, and I guess just to reinforce that, one of our mantras with clients is to work on the business, not in the business. And what this situation has done for a number of clients that are either being forced to close or have had their income significantly reduced is the owners are now getting that time to work on their business rather than in their business. So they're doing things that they've been meaning to get to for the last number of years. And that should put them in good stead for the coming 6 to 12 months.
Absolutely, and with a lot of in a lot of cases, or some cases where they've had staff that have needed to be stood down, with the benefit of JobKeeper, they're actually getting that staff to come back to work in a different capacity and able to actually be involved in helping the innovation of the businesses. In a capacity different to what they would otherwise. And that provides opportunities for the business to kick along faster, but it also provides great development opportunities for the staff as well.
Yeah. I'll go back to you, Gary, just sort of finally, because I'm just conscious of the time. There's talk that we'll enter a recession as part of this event. How long do you think it will be until things get back to the way they were?
Yeah, very good question. Look, there's a lot of crystal ball gazing in regard to that. What I've been commonly probably suggesting to people that I think that's very much in line with what period the lockdown's going to last for and our restrictions in movement. And I've generally been quoting that if for every month of lockdown we experience, we're probably going to experience a year of a slower economy, and that probably will represent that. I think the predictions are that our unemployment rates were originally going to hit 10%. I think the perception now is they're not going to quite hit that because JobKeeper has actually assisted in reducing that number. But if unemployment rate hits, say, 8%, and if we go through a lockdown of restrictive movements for 3 months, I suspect that unemployment won't return back to 5%, subject to normal economic conditions, for a period of potentially 3 years. So virtually for every month of lockdown or restricted movement, I've been saying that's roughly equivalent to a year of economic recovery. That's even that year, particularly the first year of economic recovery, is going to be a little bit patchy also. What I think is likely to occur, and certainly a lot of the economic modelling is suggesting that because of JobKeeper and all this other stimulus measures, that in the next 6 months the economy could actually be reasonably strong, because all this money is hitting the economy. But the 6 months after is when things will start to really, for some businesses, will really start to make it tougher, because a lot of stimulus money would have been taken away, but the economy hasn't recovered. So the toughest time for most businesses, apart from what we've already been through, is potentially in another 6 months' time, where the economy will start to return to normal, but the government stimulus measures will start withdrawn. And I suspect that measures like JobKeeper and the Cashflow boost and the New South Wales government's support for small business won't go beyond that 6 months period. I think what you'll find, they'll be recovered by other measures which are more closely connected with businesses reinvesting in their business. So they'll be moving away from that emergency assistance funding into more recovery type funding. So that's something to keep in mind and eye on. I think there may be some perception out there that the recovery or the assistance money, if need be, the government will extend that. I'm not as confident about that. I think that we will see it go complete by the end of September, but there'll be some other measure put in place if need be to continue to have the economy moving along. But if anything, those businesses that particularly were and what's quite evident from one of the numbers I've seen so far, those businesses that were struggling prior to the close down will probably be getting us assistance through the through government stimulus to ease out some of those concerns they had prior to COVID virus, but they're going to reappear come September. So there's nearly a window of opportunity in 6 months to really start to develop business models that will be successful in the future. And those businesses that had models that were weak prior to COVID will probably be protected over the next 6 months, but then be re-exposed because of the lack of government funding beyond that period. So there's a window of opportunity for those businesses to look at their business and say, how do we need to re-engineer our model for success in the future? Now, that's not a guarantee that we're all going to survive the next 6 months, but certainly government assistance is so significant for a lot of businesses that it will actually protect them.
And yes, like I said, it could potentially paper over the cracks in the next 6 months. But yeah, those businesses, as you said, that aren't, poorly structured or disadvantaged from a strategic point of view may not survive the following 12 months after that.
Yeah, absolutely. And look, it's not just small businesses. There's quite a bit of commentary going around about how local councils are really struggling at the moment because they're not entitled to any of this assistance. But what it's done is exposed a model that's probably really weak in regard to their business models. So it's not just small businesses, it's even the local government level. And now that's been exposed as models that won't stand the test of an economic downturn. There needs to be potentially some re-engineering of all those business models.
And you've got the obviously the Virgin voluntary administration going on as well.
Yeah, absolutely right. Yeah.
Okay, well, we might leave it there. Thanks, guys. Just to cover off on what are the things that we need to be focusing on over the next little bit? I guess the first one is seek help if required, and Angela touched on this as well. We only get one crack at this. This JobKeeper payment, we only get one go at it, so we need to make sure that we're certainly maximising the amount of money that you're entitled to, and we do dot the I's and cross the T's. So if you do need a hand with that, please reach out to us. We've had a number of clients ask for assistance in this space. So again, just sending that message out as well. Registering for JobKeeper, or enrolling for JobKeeper, that needs to be done by the 30th of April. That's got to be at the top of your list, definitely. We need to collect those employee nomination notices because, as Angela pointed out, we need to, in order to be eligible, we need to have paid our employees. We want to make sure that we're only paying the ones that are eligible. So if there's a job to do this week, it's actually get those employee nomination notices out and then make sure that they have been returned and doing, obviously before the end of April, doing the payroll. Put arrangements in place for ATO debt. As Angela again pointed out, that's going to impact on how that cash boost is going to come back to your business. So we need to make sure that those arrangements are in place, certainly prior to lodging your March BAS, which leads on to actually lodging your March BAS. So those people that are due refunds will be able to get them, and those that will cash flow boost will offset the March BAS. It's probably less critical in terms of timeframes. Just to touch on what Gary and Nick said, I think it is really important to prepare a cash flow forecast for the next 12 months. We're now a lot clearer about what the next 6 months looks like in terms of that survival mode, but we need to prepare for the 12 months, the next 12 months, even the next 18 months. What impact is a downturn in the economy going to have on your business, and what things can we be doing now to make sure we're going to be able to cope when the stimulus ends. And I always like to end on a lighter note, I guess, but this is something that I've been thinking about. Start planning your next holiday. It's the bit of the light at the end of the tunnel. It may not be an overseas holiday. It may not be an interstate holiday, but at some point you will get the chance to get away. So start thinking about it. I think it's important that we start thinking about the way forward because it gives us something to strive to and gives us some purpose when we're stuck at home looking after kids and homeschooling kids and all the other challenges that we're faced at the moment. So that's probably it for us today. I'd probably like to, just before we go, a big shout out to our staff. Our staff have done a fantastic job over the last month attending to clients. The feedback that we've had from clients has been fantastic, that our staff have been there for them. So we really do appreciate that, and particularly the time that they're investing in themselves in relation to a lot of this additional learning that's going on, the responsiveness of getting back to clients, all done working from home under less than ideal circumstances. So I just wanted to make a point to big shout out to our guys, and we're really enjoying our Friday Zoom meetings at the moment. We're having themes. I'm not sure what the theme is for this Friday. So it will be good to have everyone back in the office, but for the time being, we are really appreciative of all the work that everyone's doing. So on that note, we'll sign off. There'll be a recording available of the webinar. If there's a few late questions that have come in, which we'll endeavour to go back to those people directly with the answers. So that's all from us. Stay safe, and we're running another update webinar in the coming week or so. So thanks everyone.